Hello students and welcome to the lecture. So students, as we know that we are covering the general awareness and basically what we are discussing about the static economics. Alright, so far we have completed several topics like the microeconomics, macroeconomics, law of demand, law of supply. Alright, in this lecture, basically what we are going to discuss, about the monetary policy. All right. So the monetary policy is going to be our point of discussion in this lecture. All right. And what we are going to see, all these aspects. Like we will have a discussion over the monetary policy overview. We will see the interest rates. We will see the money supply. Okay. We will see the exchange rates. We will see reserve requirements. We will discuss the forward guidance, inflation targeting, economic indicators, stability, globalization, fiscal policy, and political factors. Okay, so now you can see that these are the topics we have to discuss in the monetary policy part. All right, so with this note, let's begin, and please pay your attention here because it is very, very important topic from the economics point of view. All right. So this is the monetary. Okay. Now let's start. Monetary policy is a macroeconomic policy implemented by the country's central bank. Okay. So monetary policy is a macroeconomic policy implemented by the country's central bank to manage the money supply, interest rate, and overall economic conditions. All right. Like basically, so far, what I have told you about the micro and the macro part, right? Okay. In the micro part, what did I tell you? I tell you that it is for the smaller segments. Okay. And what about the macro part? It is for the larger segments. Right? That's what I had told you. All right. So when we talk about the monetary policy, basically here the terms monetary signifies money, supply or money aspect. Okay. This is the monetary. Got it? So now in this policy, basically we are considering the entire country. Okay. As far as we could have a control on the territory, or you can say as a Indian territory, we having the monetary policy. All right. So we are covering that money supply. That's why it is the macro concept, because right now we are not talking about basically, you can say, we are not talking about an individual market, an individual customer, a particular city, state, or whatever you can say, but we are discussing about the entire nation. All right. So that's why it is the macro part. Okay. Second thing which we could see here, it is being implemented by the country's central bank. Okay. In the case of India, it is implemented by the Reserve Bank of India. Reason being, the Reserve Bank of India is the central bank of the country. Got it? Now, the primary goal of the monetary policy is typically to achieve price stability, control inflation, support economic growth, and maintain the financial stability. All right. How these things are possible? Let me tell you when we go ahead. Okay. Right now, I'm just going to give you the overview about it. Price stability is the aim. Control inflation is the aim. Support economic growth is the aim, and financial stability is the aim. All right. So these are the main aims behind the formulating of monetary policy. All right. Third is that central bank uses tools to influence the money supply and interest rate, which in turn affect economic activity. Okay, like as I have told you, or as we have discussed basically, that the central bank of the country, in case of India, it is the Reserve Bank of India. All right. So the Reserve Bank of India is basically, you can say, responsible for making of the monetary policy. So we should understand by this self that this is to be required to maintain the various tools so that they could formulate an effective policy, right? So this is what we have to understand, like what are the policies, what its influence, what is necessity and objectives. All right, so let's begin our discussion over. Okay, sorry, further, not over but further. So we have completed the overview part. Okay, the next we have to discuss is the interest rates. Okay, central banks set a policy interest rate such as the federal funds rate in the United States or the repo rate in India as a key tool for influencing monetary conditions. Changes in this rate can lead to changes in borrowing costs for businesses and the consumers. Basically, if we talk about it, okay, repo rate. What do you mean by this? It's basically the percent of interest chargeable on borrowings from central bank. All right. So repo rate is basically, you can say, the percentage of interest which is chargeable on borrowings from the central bank. All right. And me and you, we are not the customer of central bank. How many of you have your accounts in the central bank? How many of you? No one, right? So it means that the financial institutions and the banks, basically they having their accounts in the central bank, right? So now the question is how their account in the central bank can affect the money supply of ours. Okay, let's understand by an example. Okay, suppose this is the bank. All right, this is the people. All right, so basically what happened, bank grants the loans to the people. Okay, and these loans basically enhance supply of money, right? Got it? Why? Because when you have money, you will spend it, right? So that's why the more loan you get, the more money you have, and then you expand it more. All right. And this basically enhances the supply of money. All right. And remember the golden dialogue. One man expenditure another man's income. Please keep this thing in your mind. One man expenditure, another man's income. How? Let's take an example. Suppose you go to the restaurant with your friend, your girlfriend, your boyfriend, whatever you can say. Okay, there you have consumed the food. All right, you had spent a good time. In return of this, you had to pay something to the restaurant. All right, it means that suppose your total bill was for rupees 1500. Okay, or you can say about 4000. You go to the expensive restaurant. Okay, about 4000 is your total bill. Got it? So it is the expenditure for you because you have to give it away. But when we talk about the owner of the restaurant, it is the income. Got it? So one man expenditure is another man income. All right. So now the people who have taken the loan from the banks, they will expand it in the market, right? And this will be the expenditure. And if this is expenditure, so it is the income of those businesses or those persons on whom the amount has been spent off, right? So it means that their availability of money will be increased up, their income will increase up, and when the income increases, the consumption increases. Okay, like suppose you are earning rupees 10,000, all right, and now you are not consuming much things. But when your earning will be 40,000, 30,000, 20,000, automatically you will start spending more and more, right? So the same thing applicable in this case also. Okay, so when the consumption grows up, the demand grows up, right? And we know when the demand grows up, the prices grows up. Okay, and this will be the condition of inflation. Now get the little bit picture. Okay, so these banks basically required the fund with themselves so that they could grant the loan. All right, and here comes the RBI or the central bank. Okay, so suppose they are granting the loans to the people, their funds will be degraded off, right? Because if you can assume that this bank having the 100 crores, but they are granting the loan to the people, all right, so the 100 crores will be diminishing. All right, why the bank is granting the loan? Because they are earning the interest. Okay, it's a income part of them. All right, so after some time the bank will reach the central bank and borrow the amount, okay, so that they could grant it to the people. Got it? This is the general mechanism. All right, now here understand the picture that the bank, people, and here comes the central bank. Okay, the bank. The bank is granting the loan on 9% interest rate, and the bank has taken the loan on 6% interest rate. Okay, so the 9 minus 6 is the 3%. This 3% is in the excess the bank is receiving, so it's an income of the bank. All right, but due to the inflation, the central bank wants the bank to grant a less loan. Okay, so for this, they had increases the interest rate from 6% to 9%. If the bank borrow the amount from the central bank, so they are now liable to pay 9% interest rate. How much they are charging? 9%. How much they are paying? 9%. 0% will be their income. Okay, so eventually the bank has to raise this amount. If they are focusing on 3%, it means that now the amount will be 12%. 9 plus 3, 12. All right, so now the people will not so much interested in borrowing the loan from the bank. Why? Because now they have to pay more interest rate in comparison with the previous one. All right, so that's how the central bank's repo rate, or you can say the interest rate, discourages the borrowing of loans from the banks. All right, I have presented a picture in front of you. You could understand it by yourself. Got it? People now facing a high interest rate because the bank has to pay the high interest rate back to the central bank. All right, so this is the picture of it. Okay, so central bank set a policy interest rate which influencing the monetary conditions. As I have told you, changes in this rate can lead to the changes in borrowing cost for the business, because when the bank has to pay the high interest rate, the bank will charge a high interest rate. All right, and this will reduce the borrowings, eventually reduce the borrowings, and when the borrowings will reduce, the supply of money will reduce, and when the expenditure reduce, the income will reduce. When the income will reduce, the consumption will reduce, and when the consumption will reduce, the demand will reduce, and when the demand will reduce, the price will reduce, and the stability will continue. Got it? Okay, thereafter second one is that market interest rate. Market interest rate. Central bank policy rate changes can affect market interest rate, including short-term and long-term rates on loans and bonds. All right, suppose short-term bonds and long-term bonds, and you can say loans. Basically, what happen when the people borrows the money, either in the form of loans for short-term or long-term? Okay, they spend it on various things. Got it? When the central bank increases the interest rate, it means that the bank has to pay higher. So the bank will charge higher. So the person who will take the loan from the bank will have to pay a high interest rate. All right. So the borrowings will be decreased, or vice versa. When the bank reduce the repo rate, the bank is paying less, so the bank is charging less. So eventually the borrowings will be goes high. All right. And thereafter the bonds formation is similar to this. Got it? Now, after this, what we have in the topic, we have the money supply. All right. And in money supply, first thing we have CRR, which we called as the cash reserve ratio. Okay. So what do you mean by the cash reserve ratio? Fixed percentage of bank reserve to be maintained with RBI in order of liquidity maintenance. Neither bank earn interest on it, nor could it be used for further investments. Okay, let's understand it. Suppose, or I think that I should give you the overall picture. Got this? Okay. Now, statutory liquidity ratio, SLR, it is a second term. It is a fixed percentage required to maintain in form of cash, gold, or government securities. It has to be deducted before finalizing amount to be lent out to the people. All right. Now, why I had told you both CRR plus SLR? What was the reason behind it? Let me tell you one thing. Okay. Suppose if the bank is having rupees 100 crores with itself. Okay. So the bank could not directly lend out the entire amount to the people. Why? Because they having their net demand and time liabilities. Okay. So if we talk about the banking scenario generally, so bank do two things: deposits and loans. Right? They accept deposits, they grant the loans in a general way. All right. So those people who have deposited their money, some of them regularly, you can say, withdraw their amount and submit it back. Okay. So this is the day-to-day activity which we call net demand and time liabilities. All right. So if the bank having 100 crores in total and the bank has granted the entire amount to the people in form of loan, so that loan could not be returned immediately. Okay. It is a term loan, either for 1 year, 5 years, and some of them will be, you can say, defaulted also. There are high chances of it. All right. So what will be the answer to those people who have deposited their money? They will be find themselves in a ditch, right? That's why, as per the RBI, the bank has to maintain the CRR and the SLR, cash reserve ratio, statutory liquidity ratio. What do you mean by this? Let's understand. Suppose if the 100 crores is the total value, okay, so the first come the CRR, the second come the SLR. Okay, their percentage has been revised by RBI time to time, you can say, based on the inflation in the market. Okay, so suppose if the CRR right now is 6% and the SLR right now is 4%, for example. Okay, so 6% of, you can say, 100 crores will be rupees 6 crores. Okay. So 6 crores out of these 100 crores has to be submitted with the Reserve Bank of India, because CRR has to be maintained with the Reserve Bank of India. And the RBI does not pay any kind of interest rate on these 600 crores so that the bank could be earning interest. Okay. It is just for the maintenance of liquidity. All right. Similar thing is that right now, after deducting the 6 crores, how much left? 94 crores. Okay. So 94 into 4 divided by 100. How much you will get? All right. 3.76 crores. Now, this 3.76 crores has to be maintained by the bank itself. Okay. And the banks are allowed to maintain it as in a cash form purchase the gold of it, or invest it into the government securities in order of earning interest. It's depend upon the bank totally. Got it? So these are the statutory liquidity ratio and the cash reserve ratio. Got it? So that's how, if you merge them, so almost 9.76 crores has been deducted from the 100 crores. All right. So you can say 91.24 crores is the total amount the bank could be used for the granting purpose. All right. And this has to be reserved. All right. Now, how it is helped in controlling the inflation? When there is an inflation in the market. So to cut down the money supply, the Reserve Bank of India generally increases the CRR and the SLR. Okay. So that the values will be increased of, the deduction will be increased of, and the lesser amount will be there to grant as a loan. Okay. During the deflation time, when the Reserve Bank of India want to increase the money supply, they cut down the CRR and the SLR so that these values should be reduced and the loan granting value should be increased so that the bank could lend out more and more loans. All right. Thereafter, what we have the open market operations. What do you mean by this? Let's understand. Central banks conduct open market operations by buying or selling government securities in the open market. Buying securities injects money into the banking system, while selling securities withdraw money. These actions impact the money supply. All right. Like you can say, government securities is a type of investment you could do. If you purchase the government securities, suppose it's a paper, you purchase the government securities of rupees 10 crores. It means that this amount you has to pay to the government for a certain period of time, let's say 5 years, 10 years. And in return of this, you will earn a regular interest rate of 8%. All right. So it's a type of investment. Got it? So basically, when the Reserve Bank of India wants to cut down the supply, all right, so they generally sell out the securities in the market so that this is the person who having the, you can say, money, and this is the Reserve Bank of India. If the Reserve Bank of India will sell the security to him, he will give the money to him. All right. So the money supply will be decreased. Similarly, when there is a deflation, so the Reserve Bank of India, instead of, you can say, selling the securities, they buying the securities. If the person do not having the money, the Reserve Bank of India will buy the security back and the money will be granted him to them. All right. So that's how the open market operations works out. Remember, during that inflation time, the selling process is goes on so that the money supply could be cut. During the deflation time, the buying process going on so that the money supply could be increases of. All right. Thereafter, we have the exchange rates. Okay. Foreign exchange interventions. Some central banks may directly intervene in foreign exchange markets to influence the exchange rate of their currency. A weaker currency can support exports while a strong currency can reduce inflationary pressure. Okay. Exchange rates is basically, you can say, the value of domestic currency in ratio with the foreign currency. Domestic and the foreign. All right. And it is totally dependent upon the basic rule of demand and supply. How? So far, what we have studied that if the product's demand is low, but the supply is high, so the prices will be goes down. Similar thing happens with the currency. If the demand of the currency is low, but the supply is high, so the value of the currencies will be decreased off. Vice versa, if the demand high, but supply is less, the value of currency will be increased off. So what the central banks generally do, if they're finding out that the values of the currency goes down because the supply is more than the demand, so they generally cut down the supply, okay, so that the supply should be in matching of the demand. All right. But deliberately also sometimes we increases the supply so that the value could be goes down. Why? Because we have to increases the exports. And how it is possible? how we could increases the exports by downgrade the value of our currency. It is a very simple phenomena, you can say. Suppose this is your export value. All right. Okay. I think that I should give you a basic introduction. Then only you can understand it better. All right. First of all, we have to study about the currency supply. Okay. As I have told you, downgrade or degradation. When it happens, supply is high, demand is low. All right. Thereafter, second case, what we have the upgradation case. Okay. Upgradation case is that supply is low, demand is high. Okay. So this is the general rule. Okay. So what I have told you, in order to degrade the currency, the supply generally increases, the demand is down. In order to upgrade the currency, the supply is generally down, but the demand has been increased off. Okay. So how weak currency matters in export promotion? How it is possible? All right. So let me give you an example. Suppose if we talk about the Indian rupees, 83 Indian rupees is equal to 1 US dollars, right? This called the exchange rate. What do we call it? We call it as the exchange rate. In order to convert the Indian currency into the US dollars, you have to pay 83 Indian rupees in order to just get 1 US dollars. All right. So right now it is a case of degradation. Because if you compare the values, the Indian currency is weaker one, but the US currency is stronger one. All right. So how it matters in the export promotion? Now, suppose this is India, okay, and this is some person who is sitting in the USA or America. All right, let me create person in the US or America. All right, now this person just, you can say, spend 2 US dollars, okay, and he will get a thing worth rupees 166. Okay, so in simpler terms, you can say he has to spend less, okay, and he is gaining more. Okay, so that's how the exports are promoted, because that's why the person who is getting more in spending less, they will incline towards the products of India. Okay, so our Indian manufacturers could get a chance to sell out their products into the foreign market, and this will bring us the foreign currency. Okay, and this foreign currency will be used to maintain the exchange rates and catered imports. Got it? Exchange rate, how? Suppose if we have the US dollars and we have the rupees, okay, we generally want to downgrade the rupees value in order of the USD because it promotes our exports, as we have seen the example. But here is one thing also, that the stronger currency can reduce the inflationary pressure. We generally forget that the weak currency could promote the exports, but it could also create inflation through imports. Why? Because in order to getting the think of worth $2, how much you have to pay? You have to pay rupees 166. Okay. So now you can say that you are paying more but getting less. This is the inflation part. All right. So that's why in order to maintain the healthy exchange rate, we want to downgrade the rate, but we do not want to downgrade the rate as up to extent that we have to face a immense inflation, right? That's why what we generally do when we find out that the supply is generally high of Indian rupees and the demand is generally low. Okay. So what we do, we started on selling out US dollars. Okay. When we do this kind of thing, what's happened? The rupee from the circulations goes back to the Reserve Bank of India and US dollars come into the circulation. Okay. So in this case, the supply of US dollars increases off, but the demand decreases off. Okay. So the value of the rupee will be upgraded in comparison with the US dollars. All right. Similarly, when we want to downgrade the value of the rupee, what we do? We generally start buying the US dollars so that the US dollars from the cycle will go back to the Reserve Bank of India and rupee will come to the cycle. Okay. So that's how the exchange rate has been maintained by the Reserve Bank of India and the central banks. All right. So students, basically till now, whatsoever we have completed the overview, interest rate, money supply in the exchange rates. All right. In the next lecture, we will continue with the other topics as well. Till then, just revise all the facts and figures we have discussed in this particular lecture and be ready for the other lecture. With this note, let's end this lecture and say thank you.